here at Business Law Toolbox. We're going to talk about how to become an angel investor. We have now a 6-episode series that you can watch and learn exactly how to become one. And today we're going to start with a checklist that you will need to start your journey to become a real good angel investor. So don't miss out on this one, because this episode is going to give you a real start for your successful career.
Amazing.
Let's go.
Hello.
So, Kat, you're going to take us through the checklist today?
Yep.
And I can put it this way.
Yes.
I got 2 million because I sold properties. And now I would like to take the next step and become an angel investor. And this world is very new to me. I mean, I've heard about it. I heard good stories. I heard bad stories. So what I want to know is, how do I continue this journey? Because I'm so curious, but I'm also a bit nervous.
Yeah.
So that's why I'm asking you.
Amazing.
Where to start?
Yes. Well, when we did the checklist, we figured we would help out like an overview and a confession. When I did my first angel investment, I did not do a checklist at all.
So you're going to teach me all the do's and don'ts now?
Yeah.
Thank you.
I've done the mistakes myself. Being a business lawyer, I have worked with it for over 10 years when I had my first opportunity 7 years ago to make an angel investment. Completely just fell in love with the founders. I just went for it. But I've seen so many mistakes, my own and others. So that's why we're going to go through this 6-episode masterclass. And this first episode will be very high level. So if you feel very, very savvy already, skip to number 2. But I'm going to say this will also help founders looking for investment to understand the angel investment perspective. So you will have an easier time getting your investment. And also, if you're like me, you already jumped in the angel investment world, it can help you kind of start prioritizing, getting a better grip around where you're going, where you want to go. So I know it still helps me to review this checklist every now and then. It really does.
That's so good.
Yeah. So number 1, self-assessment. Because knowing the name of the game, do you have the financial stability? Because any investment that you put into a startup, please think, is it okay if I never, ever see this money again?
That sounds a bit scary.
Yeah.
Yeah.
And it's harsh, but it's a high risk, high reward type of investment. And typically you say that you should not use more than 5 to 10% of your savings for this type of high risk investment. But I mean, that depends on your situation. Do you have a family? What's your overall savings? How are you a billionaire, or do you have, or are you young and single and you feel like you can take a chance with some of your money? So I mean, so it's up to you.
But it's also a bit of the charming part, you know.
I know, it's okay. But do a self-assessment. Can you feel like I can afford to take a high risk? So self-assessment and financial stability. Are you ready that you will not see, even if it goes well, you will not see any return of investment for a long, long, long time?
And long time could it be years?
5 to 10 years, I would say. Yeah. So if you change your mind in the year and you want to use that money to buy a car, don't expect to get it back. So that's the name of the game. So again, self-assess. Feel where you are at.
So be patient.
Be patient.
Okay. If we take it to the next step, what should I think of then?
Well, number 2, I'm going to say build your network. Because as you will learn, the angel investment in the startup world is a contact sport. It's all about who you know. You will not get in on the great startups, and you will not be able to attract other good investors to that startup unless you have that network required. So build your network. Start with thinking, who do I know already? I mean, that's number 1. But also, how can I grow my network? If you don't have any contacts or know anybody right now, I mean, if you've been in real estate, most likely you have friends who are already putting money into startups. So start asking around, listening, right? But if you don't, check online. Are there any networks in your hometown? Are there any online networks that you can join? I mean, just checking out YouTube channels like this channel. Write the comments, see what response you get. So, I mean, today it's easier than ever to reach contact and get new inputs, so to speak, new connections, knowing new startups and what's going on. But it will take time because, again, the best startups are already quite attractive. So,
yes, and this seems quite scary because I can do my work in property and real estate, and then I'm just gonna head out and say, "Hello, I'm an angel investor," but I really do not feel like that.
No.
But I need to meet like other people in the same sport.
Yeah, exactly. And that's a good comment because angel investments typically say that's after the startup has gotten its first founding, which you say is from friends, family, and fools. But I mean, where do you draw the line between being a friend, doing your first investment, and being an angel investment worth writing it on your LinkedIn profile, right? I mean, so that's, I mean, everybody, all of us will grow into that role. And some people want to brag about it, even if they put in like 10,000 investment or something, I don't know. And some people will never brag about it, will never put it out on LinkedIn. And I mean, it's up to you. Nothing's right or wrong. That's your profile, how you prefer to present yourself, really.
Wow. So network and new knowledge.
Yeah, new knowledge. I would say that's number 3.
That's number 3.
Educate yourself. Right on. So not only by talking to people, check out YouTube channels, read blogs, listen to podcasts. There are many fantastic founders talking about their journey, often also providing stories about previous startups that failed and why they failed and so forth. So you will learn a lot. People are very open nowadays.
Yes, but it feels like a big world because when I'm searching for like angel investment, I need to somehow have some foundation of what I believe in.
Yeah.
Because otherwise I get too, it gets very confusing watching everybody. Yes, it's overwhelming.
And I would say that number 4 would be set your own strategy.
Wow.
Because many will say to you that you need to diversify. You need to have 20 to 30 startup investments over time in order to have like the best opportunity to kind of get that return. Because the basic fundamentals of it will be that most will fail, and that is okay. Most will fail, some will go okay, and one will hit it big. But that one that you invest in that hit it big, that will cover all of the other investments by far. So you can't expect to all of them be okay. No. It's not that type of game. Most fail and you just need one winner.
And that's what you're hoping for.
Yeah.
That's like a part of the game, it feels like.
Exactly.
Yeah.
So when you talk about your investment strategy, it can be diversified like crazy, or it can be that you want to keep within real estate because that's your expertise. Because, there's a quantitative aspect to startup and it will be a qualitative. And for you, it might be that qualitative that you know the real estate sector, so you can assess, so you can contribute. Because number 5
is
find your value add. A good angel investor will not only come with cash in hand.
Yes.
They will come with either a network or experience or both.
That was what I was supposed to ask for.
Yeah.
Yeah.
So in your case, it might be that you're super attractive for startups within real estate and so forth. Because you might contribute in a way that they could never dream of and they could never afford to pay you a salary. But if you've come in as an angel investment, you might be worth gold to them, right?
Yeah. But in my case, I'm interested in, for example, a food tech company. I can tell you more about that later. But how should I think that? I don't have so much experience from food tech or food or restaurants. I only have like restaurants properties, but that's it. So what can I like give the startup or the company I'm funding?
Well, you need to have a dialogue with the founder, understand where they're going, what kind of strategic partnerships are they looking for, what kind of knowledge do they need from you owning property with restaurants in them, what kind of drives that, And perhaps there's no match.
No.
And perhaps it's a perfect match.
Mm.
And perhaps they're fine with your money and they want your calls. I mean, so it's very individual.
Mm.
It's not like one size fits all.
No.
And also when I say find your sector, it might just be opportunistic. You might not at all feel like real estate is, you tired of it, you hate it.
Yes.
You want to have every sector in the world aside from real estate.
Yes.
So it's all about kind of soul searching and going out to the world, talking, reading, understanding what you're willing to go for.
Yes. But I also feel like, I'm willing to learn new things. So I'm willing to cooperate with the founders and learn how can I help with my experience, but also add something new to, I mean, it's a new food tech app. So maybe I have something or maybe I can learn something.
So in your case, a value add will want to be that you want to be active, very active. So if you come on in early, that can be really attractive for a lone founder or a very tight, small team. And for another startup, that just might sound super annoying. I don't want you in here every day, please. No. So again, reflect and have a good conversation, communication with the founder. So you make sure before you do the investment that it's a good fit.
That it's a good fit. Yeah, that's good. And if we move on to the next step.
Number 5. I'm going to say, in a good case, before you meet that lovely founder that you fall in love with, like me, you do a checklist about what due diligence you need to do. Okay, and due diligence we talked about in an earlier episode. It's like the audit. Yeah. It's the investigation of the company. And when you do it this early in a startup, you need to be realistic. I mean, it's not like you're going to buy the company or you're a venture capital company. So the company won't have that much. Perhaps you're investing in a PowerPoint presentation. Then you might want to do a due diligence looking at the commercial market. Do you believe in it really? What's already out there? How that product really works? You might want to do a due diligence on the founder. She seems amazing, but what's her track record? Has she successfully built other companies? Do you know anybody that knows her? Does she have a good reputation? I'm not saying that you should trust rumors, but check around. What do you want to know? And if the startup has a prototype, can you talk to customers? You want to check the legal structure. You want to ask for the cap table of the startup. So think it through what you need to know. Or if the startup makes claims that it has IP, is that protected? Can you see some validation? If it claims that it has customers, can you see the contract? Can you validate it? So, and sounding a bit harsh for founders here, but without saying that they by any means mean to be deceitful, they are very, very passionate and they see the vision, they believe. So it does tend to happen that they will come to you and say, well, I have 20 investors lined up and everything's going great and I have 5 customers. And then we start asking about those 20 investors. It turns out, well, I had coffee with 20 investors, but I know they will invest. And I know I have the phone number to those 5 customers and I talk to them. I know they will buy. So be careful. Think it through. What kind of validation do you want to see? Because a founder is and should be positive.
Yeah, of course. Otherwise, you won't invest.
No, but you should also be a bit level-headed in that case.
A bit mindful, you would say. Yeah. Okay, then I will take that with me. And the next step.
Where are we at? Are we number 6?
Yes, we're heading to number 6 now.
Lovely. I would say find your hunting ground.
Oh, what does that mean?
That means that even if you feel like, okay, I'm so savvy, I read all of the books and listened to all of your episodes on that YouTube channel.
Yes.
I know everything. And I know that I want to invest in the same companies that Mark Zuckerberg invests in. And I want to meet Elon Musk. And I know that anything popping out of Silicon Valley with a focus on AI is perfect.
Yeah.
Well, I know for myself, it's not my hunting ground. I do not have Elon Musk's phone number.
No, even though I wished I had.
Yeah, exactly. So it's not realistic for me to believe that those are my startups. So, like, which type of startups do I want to invest in and can I invest in? Where am I attractive? And where can I reach them? Is it the local community? Is it within the real estate and those communities globally? What's your hunting ground? Where can you find them?
Yes, and it feels like when I listen to you, you need to have some kind of like self-awareness. Even if I had a lot of money, I need to, as you say, find my hunting ground.
Yeah.
And I mean, I have to give something to the startup as well for the company.
Yeah.
Oh, okay, yes. Because if you have like money to do things, you get like, yeah, I can do this and that.
Yeah.
I'm going to call that person. But some strategic, you need to be aware.
Yeah, exactly. Kind of realistic. Like, where am I? Where do I want to go? So you don't feel disappointed later on. So you don't.
Yeah.
I mean, if you invest like up to 1 million, and then you see no result from them, and you might not even be on that good communication with the founders, and then might not be that fun. You might not even have that good reputation in town because you didn't really know the name of the game and so forth. So might as well kind of reflect. Like I said, I reflect like at least yearly on this checklist.
That's good.
Yeah.
So we move on to number 7.
7.
Yeah.
The last one before we kind of pull the trigger. The boring one.
The boring one.
The boring one. Think about tax consequences before you invest.
Wow. Okay, what should I think of then?
Depending on where you live.
Yeah.
For instance, it can be beneficial for you to invest through a holding company. So you might want to set up a company, invest through that, because then any dividends from the company will be treated tax neutral. It's like that for us here in Sweden, for example. So review that before you invest, because it can be quite a big difference if you do it right or wrong, so to speak.
Okay, good. So be aware of that.
Yeah. And also if you want to kind of provide services and get equity for that, sweat equity, will there be VAT issues and how will you structure that? Or is it a risk that you would be seen as needing to pay income tax if you contribute and come and work and get sweat equity for that? So be mindful of the tax consequences before you jump in the game.
Wow, good. Next, now we're heading to number 8.
Number 8.
What's happening now?
Do it.
Yeah.
Invest.
Yep, I'm going to do it.
The best recommendation, start small.
Yeah.
But you're you, so I won't hold it against you. But start small and just invest.
Try. So let's say I have 2 million.
Yeah.
Would you recommend me to invest maybe half of it at the beginning? Or if I have the opportunity to put all of my money, if it turns out to be good?
Do you really want investment?
Yes.
I would definitely say, are we talking dollars?
Yes.
Yeah. I would definitely say no. But my recommendation, up to you, I would say like start with 10, 20K.
Okay.
Yeah. And then you can reflect, are you willing to do add-on investments in the same startup, or do you want to spread between different startups? Because if you want to defend your ownership stake, you might want to participate in one or more funding rounds. And then you will typically not be able to, because then they will be too big. I mean, the VC funding rounds are typically not 2 million will not suffice. But that can be a reflection, but start small. That's much
really
my recommendation.
Yes, thank you.
Yeah. And then we're at
number 9.
Number 9, I'm so sorry. And that is stay active, monitor the investment, and then you will have room to navigate. You will have learned, you will have met other startups, you will have discussed with other angel investors coming into the same company. And then you will know if you put in to the 20K, where do you want to put in the next 20K or 40K? Because I promise once you get in the game, the opportunities will come and come and come. And if you put out on LinkedIn that you're active angel investor, if you get a good reputation from your current founder and fellow angel investors, you will get so many opportunities. So don't jump the gun too much, because then you lose out on the fun, but also financially won't be sound, because the more you source, the more you learn, the more opportunity to find really, really good startups.
Wow. And now we're heading to number 10.
Number 10, well, that will really be reassess, reevaluate, and keep going. So number 9 and 10 kind of boil together right now in how we present it.
Yes. Do it and
reiterate the process. Perhaps it changes over time. Perhaps you started out without no network, but a year in or 2 years in, you go out every weekend with different amazing angel investors who you met, and you start traveling, going to different conferences, and suddenly your value add might be your network. And suddenly your hunting ground might not only be your local hometown or that real estate or that other area where you came from originally, area of market.
Wow. I say wow to everything because I'm thinking of myself now. I'm going to invest. It sounds like a sport, you know. You talk about it as if you start, you can never stop.
No, and it's a bit sports. It's good because also if you think that you were a coach and you had a team, well, you're looking for that one Michael Jordan, right?
Yes.
And in order to find that Michael Jordan, you need to be a good coach, but you also need to find very many to coach along the way, right? So kind of like that, you need to find that one winner, and then you can find a lot of ones that go well during, and you get to do something you love. Because, I mean, I've never done anything that I'm more excited about and more grateful than my own angel investments.
That sounds really good.
Yeah. But again, any money that you put into angel investments, be ready to never see it again. So,
yes.
And it's not legal advice. This is just our checklist, storytelling, education, telling it, supporting you in any way we can.
Yes, you hear the tips and tricks from our business lawyer. She sees it from the inside.
Yeah.
And this sounds very interesting when you talk about it. I mean, I get very excited, but also the risks is maybe the reason people are afraid of starting the angel investment.
That's very interesting because do you think the people that do not do angel investments, do they realize the high risk? Because I'm not sure.
I'm not sure either. Because, I mean, if it's a really big risk, I can get butterfly from just the idea of it.
Yeah.
But I'm also a bit scared, but then I know maybe it's a good jump to take. I don't know.
No? So
I don't know.
No. And I mean, since there is a quality element, just about picking the founders and also how you can contribute yourself, you can have a positive impact that will at least decrease the risk to some degree.
But you can never decrease it totally.
No. It's high risk. We're up here with the risk.
Wow.
Yeah.
It sounds amazing.
Yeah.
And now we've gone through the checklist. I mean, so now you have some tools to start thinking about to become an angel investor.
Yeah.
Sounds so cool.
Super.
And you got it here on the Business Law Toolbox. We're always here to represent business law for you at zero cost. And you have now watched our first episode about angel investing and how to become one. So stick through because there will be 5 more episodes about this, both legal parts and good lingo. So stay tuned.
A lot of mistakes seen that we will help you so you have heard about them and you do not have to do them.
That sounds great.
Yeah.
Because that's what we want to hear.
Yeah.
So thank you so much for today. And please, I'll see you next time. Don't miss this. And do not forget to like and subscribe our channel because we are here to keep us educated and keep you educated.
Indeed.
Stay tuned.
Bye-bye.
Bye.
The problem that they're very, very sure about their revenue going hockey stick. But you will learn a lot about the founder if you call them up and question them. How do they react? How do they respond? How do they reason?
Welcome back to the channel. We are now presenting the second masterclass of how to become an angel investor here at Business Law Toolbox. And we have Kat with us, our business lawyer here as usual, and she's going to take us through a really crucial thing when you're new to the angel investing. So stick around because this is going to be very, very important to know if you're about to be an angel investor. And for me, as I mentioned in the first episode, I had 2 million from the real estate that I got in profit. And now I want to start angel investor.
Yeah.
But it's a lot of things to think about. And now when I'm do the research, I mean, there's a lot of documents you need to get it right.
Indeed.
Because I'm a bit insecure to start in this world. It's new to me. I don't know how to act, what it is, or anything. So, but I'm very curious.
Yeah.
That's why I'm doing a lot of research. So I've seen a lot of different documents that you might need, and Kat's going to explain it to us today.
Indeed.
So the first thing that I got over was pitch deck.
Yeah.
What is it?
Well, basically, that's a selling presentation of the company, of the startup. So the pitch is what you send over to angel investors. It shows the core business idea, the market opportunity, the team, everything that's really relevant. Some kind of financial prognosis, where you think you're heading, etc. Typically like 12 pages. Some go for like 40, but typically shorter, better.
And it's something that all of the companies send out to the investors?
Yeah.
Okay, good. So like a presentation, as you said.
Exactly.
Good to know. And then the second one was executive summary or business plan.
That is a short form of presentation of the business plan. So kind of a summary, like a 2-pager. So that you should expect to be able to get from the founders. And please, if you're an early angel investor, don't expect it to be 200 pages long, but do expect to get one, like a 2-pager from the founders.
Okay, that's really good. And then I have the third one, which is the financial statements and projections.
Yep. And that is also something you should ask for before you do your investment. And that will be both like the budget, really, both currently and forward looking. If they take in, say, 2 million. So the financial statements, that will be both current and forward looking, like a budget. What do they expect to have in costs and what do they expect to have in revenues, etc. So like a financial statement, but also prognosis. And what you should know about the prognosis part is that very, very typically it's too positive.
Okay, and what do you mean by that?
Too much revenue too early and too little costs.
Okay.
So do scrutinize it. Do you believe that it makes sense? Do you believe that the money you put in will last as long as they predict, etc.?
And if I do not believe them, what do I do then?
Question it. Because again, a founder should be positive. So maybe it's not the problem that they're very, very sure about their revenue going hockey stick. But you will learn a lot about the founder if you call them up and question them. How do they react? How do they respond? How do they reason? So that can be a really good telltale.
Oh, wow, to get to know them a bit. And then one more thing is the due diligence checklist.
Yeah. So the diligence we talked about, that's the investigation of the company. And for you, at this early stage, you should have some fundamental checklists. You want to see specific documents about the company. You want to get some verification if they make claims about intellectual property, etc. So a checklist will be something that you need to have confirmed or checked before you do your investment, so you know that it's a sound investment to make.
That's good to know. And the next one is the intellectual property. And we talked about it before. But as a document, what can I expect?
And that will depend on the type. And both where in the process are they. Is it something within pharma or health, or do they claim that they have a patent? Then you want to see the registration, right? Or is it something that's proprietary for them? You want to know. So you want some kind of validation, and what that documentation is depends on the claims that the startup makes. And perhaps there is none. Perhaps it's just a great ambition, but then that should affect the valuation negatively, or it makes it so that you might not feel that you want to invest at this stage.
So it could be very crucial.
Yeah.
Okay.
It's a minefield, the IP.
The IP.
Yeah.
Remember that.
Yeah.
So we're heading out to...
Document?
Yes, the documents. The articles of association.
That you will want to ask for from day one. I know many of you don't, but me being a lawyer, I'm going to say it. That's the core fundamental document about the company. And really, you want to know that's properly incorporated. You want to know what type of shares and how many are issued and how many are authorized they can issue. What's the share capital? What's the board compilation? How many? Do they have an accountant? Etc. So that's kind of the core document of the company. And the company, that's where you're putting your money in. So kind of the receipt.
Receipt. Okay, but this is a good one.
Yeah.
And then also the cap table. We talked about it. We have 2 episodes of it.
2.
A must see. It's a really good one. But tell us a bit more about it.
It's the Mecca.
Yeah.
It's the ownership of the company. It's the structure, and typically it should both show the current ownership of the company. It should also show the fully diluted ownership of the company, informing you if they have any promises for future equity outstanding. And also, it should include future funding rounds. So not only the current state, if they're planning a new funding round, it should say pro forma, and you should see what happens to the ownership at that funding round. So it's a bit of the Mecca. I mean, it is an investment, right? This is the tracking of your ownership and your return of investment in the future.
And you can also see like historic data, which people have been invested before and such things.
Yeah, I would say yes, the cap table should also help you discern what has happened before. It should be layered in that sense.
Good. I learned that the cap table is very important.
Yeah.
So, and the shareholders agreement as well. We have an episode about that one too, but never mentioned too many times.
No, if you enter into as the first investor, it might even be the case that they don't have one yet.
Oh.
It might be the case if you're talking to a first-time founder and you're the first investor that he or she is talking to, that they haven't put that yet because they're the only owner of the company. But as soon as you have an investor on board, you need to have it because it governs control rights and economic rights. What happens in the future when you bring in new investments? Should you be allowed to participate again or not? The governance right, who can appoint a board of directors who has reserved matters, can say yes or no to specific type of actions. So it's key.
Is this like mandatory for companies to have?
It isn't.
It is
so,
not.
So like I mentioned, if it's a one owner, one founder, he or she might not even have one today. So you might need to help out to bring it together. And there are great varieties in the shareholders agreement. So don't think you can just download one and it will be standard boilerplate, sign it. I do warmly recommend that you read it and you get legal help before you sign it.
Yeah, that's a good one.
Yeah.
And convertible note or SAFE.
It can be the case that the founder that you are talking to wants to offer you a SAFE instead of equity shares directly. That means that you instead invest with a promise for future equity. And convertible also is a loan today that can convert into equity in the future. So if that is the case, and that's typically when you cannot set a good valuation today, and in the US, a SAFE, simple agreement for future equity is very common, then you should need to know what are the terms for conversion. Is there any discount? Is there any cap on the valuation? Do you always have a right to convert? Do you have any right to interest if you don't convert, etc.? So read carefully if that is the offer that you get.
Okay. And then the share register.
The share register, once you have invested, that will be the proof of ownership. So, I mean, it's like if you buy gold, you want a certificate knowing that it's gold, right? That you own. You want to know you own the shares. So make sure to ask for a copy of it so you know that you've been inserted properly. Because many first-time or stressed founders might not even think it through. And I mean, I've seen all of chaos.
I can imagine. You're so happy you can invest and do funny things and then you forget about some things.
Yeah. So ask for a copy. And before, it was typical that you got a physical share certificate. But now in the modern days, most countries, you don't need to anymore. So it will be that digital share register. And that, when you're in that, you have the economic rights of your shares and the governance, the control rights. But you need to be, so you can participate in general meetings, get your dividends, etc.
Okay, so make sure to have one.
Indeed.
So we're gonna keep through.
Very dramatic.
It's very dramatic here. It's a lot of things. So, and then we're heading over to the term sheet.
Term sheet.
Yes.
I would say if you're early angel investor, most likely you will not have a term sheet. That will come later on when we're talking about venture capital, bigger investments, bringing them on. So what you should know about the term sheet is typically non-binding, but they will describe the general terms of the next investment deal the value of the company, what type of shares. Do they get preference shares? So they prefer that at a liquidity event? What kind of control rights? Will there be vesting requirements for the founders, etc.? So it's very important. And for you as an angel investor, you will want to know if you have to participate in like warranties, etc. And we'll get to that when we come to the investment agreement.
Yes, which is the next one.
Yes. So that's the formal long-form document that the term sheet reflected. And that will describe the new investor coming in and on what deal terms. So like I said, early angel investor, typically you don't have it. But bigger VC, you can also incorporate it in a new shareholders agreement. You can call it a subscription agreement. You can call it investment agreement and the shareholders agreement. Basically, terms of the investment. And what I want to say as a red flag for you as an angel investor will be check if there are warranties that they want you to give. Because sometimes they will ask the current investors and owners to give warranties. And then I'm going to say, it's fine for you to give fundamental warranties that you own the shares you have and that they're not pledged or anything like that. But if there are business warranties, then you, as a passive angel investor, should not accept them.
And why?
Because you're not close to the business. And you can be held liable for them, have to pay damages if something ends up not being true.
Okay, that's not good.
No. So that should be up to the founders. So check that you as angel investor are only part of the fundamental warranties. That's my recommendation.
And then we have subscription agreement.
That is actually part of, that's the same as the investment agreement
It
as
is?
I mentioned. Yes.
Okay.
Yeah. It's different type.
Valuation report.
Depending on the region and what type of startup, you can do a yearly valuation report and that can have implications for eligible investors, tax implications, possibilities to issue certain types of employee stock options, etc. So be ready to have it if needed and have a dialogue with the founder if that is the case and what you use it for.
Good. That was all that I asked for. But it sounds like it's a lot of documents to think about.
Yeah.
I'm a bit stressed now when I'm starting the journey. But what would you say to begin with? I mean, what should I start with if I'm early on in the...
Early on, of course, getting a pitch deck. I would say typically an executive summary, but that's up to you. You need the cap table. You need the share register. You need to know that the company is properly incorporated, so the articles of association. You need a shareholders agreement. And in case they make claims for intellectual property, I say you want to see validation of that.
Okay.
And of course, a financial prognosis. You want to make sure you feel that it's sound and that you believe. Because remember, they will be spending your money.
Yes. Don't forget that.
Don't forget that. No, really.
So what we're talking about is like to safeguard now when you start your investment. But does everyone think about these documents when you're starting the journey?
Not at all. No. Because, I mean, so much adrenaline rush or just enthusiasm, I don't know. But it's easy to just jump in the game directly. And if you have the documentation, I mean, think about it like you're buying a house or something else. I mean, typically, then you're used to having a contract in front of you. It's the same. You need to regulate it. Otherwise, at least I would say it's that big risk of not seeing your money again, that just quadrupled. Yeah.
That's what we now want to do.
No, it's unnecessary chance that you will lose your monies.
So have the documents.
Yeah.
Wow, that's so good. I mean, I'm learning so much here and I'm really, really excited to start my angel investment journey.
Love it.
And now you've been watching this second masterclass about how to become an angel investor. And we talked about what documents you could expect and also ask for when you're starting your investments.
Perfect.
Really, really important. And we're here. This is not legal advice. It's only knowledge that we're sharing, tips and tricks that could be good for you in your business and in your career.
Tack för idag.
Tack för idag.
Hej då.
See you
Ses
next
nästa
time.
gång. to force you to sell along with them when they want to do a startup exit. Your right, very important protection for you as a minority angel investor.
We're back. And we're here to talk about business law as usual. We're so excited for this episode. Kat, you're here with us.
Hey.
The business lawyer. And this is the third episode about how to become an angel investor. So exciting. And this one, it's going to make you the smartest angel investor in the room, because now we're going through the lingo you need to know about. Really good if you're in a room with pros and you're maybe new in the game.
Indeed.
So I'm going to ask you.
We're going to keep it short, snappy, give you kind of, so you don't feel stupid. Because sometimes us business lawyers, the kind of whole startup community, we can throw this lingo around, and I mean...
And shortenings all the time.
And it can be kind of intimidating if you're new. And it's not supposed to be like that. So we're going to just shoot.
Yes.
So you heard it and you know, and you can participate. And you can also perhaps do a better job in a negotiation.
So stay tuned.
We're here for you.
So let me start with the first one. Pre-money valuation.
That is the valuation of the company before you have made your investment. So that would be a negotiation between the founder and you as an investment angel.
Okay, next one, post-money valuation.
Post-money valuation will be the valuation after your investment. And that is crucial to know, because that will define what ownership stake you will have in the company. So you will take the pre-money valuation plus your investment, and then you get the post-money valuation. And then you take your investment divided by the post-money valuation, and you will get your ownership stake in the company. So that's why it's so important what the actual valuation is, and if you're talking about pre-money or post-money.
Okay, thank you. Convertible note.
Convertible note, instead of investing and getting shares directly through a new share issue, a convertible will mean that you give the company a hybrid, a type of a loan that will in the future convert into equity. So you do not become an equity owner day one. Instead, in certain triggering events, you will become a shareholder equity owner.
Okay.
And if it doesn't happen, typically you get interest and you get a loan that you should be repaid for.
Thank you. And the next one is safe and simple agreement for future equity. What is it?
It's a simplified version of a convertible, so it's not that loan hybrid. Instead, it's a contractual agreement where you invest now, and since you cannot set the valuation, which is the same with the convertible, you set it in the future. And your investment will convert for future equity. In the future, it will convert into equity. And it's important for you to know if there's a cap, if there's a discount, etc.
Okay. Equity.
Equity, which I've already used, sorry about that. That is your ownership stake in the company. So represented by the shares. Equity, what you own in the company.
Dilution.
Dilution, that we will all of us angels will suffer that. That is when your ownership stake in the company gets diluted because they give out more and more shares in the company. So your ownership will get smaller and smaller. If your 100 shares represented 10% of the company, if they give out more and more shares, then your 100 shares will be divided by more and more shares, all of the outstanding shares, which means that they will be diluted, they will be less. So your ownership gets diluted, so it gets smaller.
Okay. And then we have the cap table.
My favorite.
My favorite too.
That is an overview, a compilation of the current ownership of the company, of the current ownership also combined with a fully diluted basis, which is any future promises for equity and how that will affect your ownership stake. It can also be pro forma, which means it can include future funding rounds and how the ownership will look like then. It's kind of the mecca of the startup investment, where you're at.
So the cap table. Next one, the exit strategy.
The exit strategy that you will hear a lot about when you come in as a new angel investor, that is how you will get your return of investment simply. So startup exit, that is how do you get a return? Do you sell the company? Do you put it on the stock market through IPO? Is there an asset sale instead? You sell the assets of the company, not the company, etc. So exit is how do you get the return of investment? How do you make money out of that startup, that value?
Vesting.
Vesting, that is when the founders or other employees need to earn their equity over time. And it's a great protection for you as an angel investor, knowing that the competence will stay in the company.
Liquidation preference.
Scary for you as an angel.
Yes, I've heard about that one.
Because you will not get it yourself typically, but a VC will ask for it. And liquidation preference will mean that you are preferred at a liquidity event. You get your monies before anybody else. If somebody has it and you don't, that will affect their exit strategy compared to yours in a negative way, typically, because you will have different trigger points.
We have an episode about that. Seed round.
Seed round, and it can be pre-seed round, many different names, but basically that's early seed, that little seed investment.
Is it to check the interest of the company, or?
No, it's it's the first early investment before you really have gotten off the ground. Most typically you don't have any revenue, you don't have any prototype, anything.
Okay. And then we have one I never heard about before, and that's Series A, B, and C.
That's subsequent funding rounds. So it's basically A, B, and C. Now we're getting to the big funding rounds, typically led by venture capital firms, bigger and better. So typically you celebrate when you do a Series C funding round. You have this great valuation. But still work to do. But basically just simply names of bigger and bigger funding rounds.
Okay. So we're moving on. Pro rata rights.
Pro rata rights, that can be really important for you as any shareholder. That's your right to participate in future funding rounds and defend your equity stake. So you do not get diluted. And once you have venture capital in, you will probably you might not have a pro rata right, and you might not be able to participate anyway. But in the beginning, it can be possible for you to have pro rata and the right and possibility to defend your stake.
And then we have drag-along rights.
That is the right for the majority of the company to force you to sell along with them when they want to do a startup exit. Very important clause.
And it takes us to tag-along. Right.
Tag-along, that's your right. Very important protection for you as a minority angel investor. It's your right to tag along. If the majority wants to sell, you can say, I want to sell at the same terms and conditions. And they need to bring you along.
Unicorn.
$1 billion company. The value of the company is huge.
So that's a unicorn.
Yeah, that's the end game, the goal. That's what every startup wants to be.
A unicorn.
Yeah.
Wow. And then we have due diligence.
Due diligence, that's the investigation of the company. It can be legal due diligence, it can be commercial, it can be financial, it can be sustainability, it can be tech, it can be any type of investigation of the company.
And then we have runway.
Runway. How long will the company survive with the cash it has or that is bringing on in the new investment? Because since you're not profitable in the beginning as a startup, typically, you will require a runway and then your money's out and you will need new funding. So that is how long do they have to stay alive with the money they have in the bank right now.
We're moving forward to the burn rate.
Burn rate. So that's how much is that negative result? How much money are you burning each month? So let's say you have a revenue of 10 and you have costs that you pay every month for 200. Then your burn rate is 190. That's
So how much
burning.
Yes.
And that will decide your runway.
Okay. And then we have the last one, and it's the term sheet.
The term sheet. That will be the non-binding agreement describing, outlining the main terms and conditions for a future investment or a sale of the company. So typically non-binding, some binding parts, which will be like the non-disclosure, it can be exclusivity, etc. But generally outlining the general terms and conditions.
Thank you so much. Now we have 20 new terms and lingo that you can use if you're new in the Angel Investor Room. And some other terms we actually have deeper episodes about, which we're going to link below. So watch them and learn even more about this, because you can never learn too much.
It's such a quick way to get savvy in the negotiation room and in any business setting, really. That's why we're doing this, because we've noticed that they're very appreciated.
Yes, just to know what people are talking about. It's really important. And remember that this is not legal advice. It's knowledge sharing. We give you tips and tricks in and about business law. Key. And that is educate yourself, as always. And stick around until the next episode, because we're going to keep doing this. And I'll see you.
Bye-bye. Hej då. Tack för idag.
Hej då.
Go and invest in a hospitality startup somewhere else, you might be in conflict with that shareholders agreement, because that might even say that you're not allowed to invest in competing businesses.
Welcome back, our business law fam. We're here at our 4th episode about how to become an angel investor. So nice.
Hello.
Kat is with us.
Hey.
Our business lawyer. So now we come to the crucial part of how to become an angel investor. And we're going to talk about what legal pitfalls you have to avoid.
Indeed.
And we have 14 of them. So stick around, because it's very important when you start your angel investment journey. Really good to know. Because me, as interested in angel investing and starting, and have some companies that I'm interested in, I really want to know what I should not do.
Well, I've been working both as a business lawyer and doing my own angel investment. So these are based on real life mistakes.
Yes, and that's what we want to hear.
Yeah, I know. And I mean, as I admitted on the first episode, I completely fall in love with founders. My first angel investment was by chance. I met an angel investor who needed some legal advice. He started telling me about his journey. He had worked on Lehman Brothers in finance. Realized that was not worth living. He moved to Sweden. He started meeting founders who want to do sustainable things. And he talked about this dream life where he advised these amazing young founders, and he wanted to make a difference in the world. And he was so alive.
I mean, how could you not fall in love
How
with it?
could you not?
Oh.
And in that situation, everything's possible.
Yeah.
Everything from making an impact to making money. And that is where we come in.
Yeah.
Because
shit can happen.
Shit does happen. And there are a lot of fallouts within the startup world. People not even talking to each other anymore. Fighting over money, disputes, or just losing their investment without a good reason. So we're here to kind of tell you about it so you don't have to make the mistakes yourself. And it will help you as a founder as well to hear them.
That's good. So we're going to start out with the first pitfall. What should we think of then?
Well, the first one will be rather obvious. Not doing a proper due diligence. Doing the checks and balances.
Yes, very important.
Very important. Angel investor, know that you're getting in the game very early. So you will not be able to do a proper full-on due diligence. You will not be able to see all of the documentation because they will not exist. But you can do the fundamentals, do the checks. If they make claims that they have customers, ask to see the validation. If they say they have a patent, ask to see the patent registration. Ask to see the articles of association. Check the background of the founders. Who are they? What have they done before? Do they have a good reputation? Etc. So do the normal checks and balances.
It will turn out to be a good thing to do.
Yeah.
In the end.
So take a step back. And we can't say exactly what they are right now because that will depend on the stage of the startup and the industry that the startup is in. So don't overshoot. That will also be a mistake, but don't undershoot.
Okay. And the next one is?
It will go kind of together, but that will be number 2, will be not failing to consider the governance and the regulatory requirements that the specific startup will be under. Because that can kill a startup.
Can you give me an example?
Well, you mentioned that you had an example where you were looking at a food tech startup.
Yeah.
So what if it claims that it makes the monies based on AI doing some kind of analysis of everybody within the region so that it can custom make exactly what they want and what they need, even based on allergies, etc., without even communicating with them? Well, then I would ask, okay, is that kind of health sensitive information that they will have? What if I have a heart disease? Will they monitor that? And are they allowed to? How do they get that? Is it GDPR or other data protection regulation? How do they know where I live? How do they know that I like to drink a big cup of black Starbucks every morning? Those kind of regulatory requirements might even make it illegal for a specific startup, or it makes it extremely costly for that startup to ever be able to launch. So consider it. It might not be a hindrance, but do make the legal check.
Good. And number 3.
Number 3, that will be overlooking the shareholders' agreement, just signing it, assuming it's boilerplate, because it won't be. There are many differences, and that will regulate your economic rights and your control rights. For instance, do you have pro rata rights? Are you right? Do you have a right to participate in the future funding rounds or not? Is that important to you? Do you have a right to a board position? You could in the beginning, because in the beginning you might be the only angel investor, you might carry the company, but you shouldn't expect that later. So the shareholders agreement, read it carefully, don't sign before you know you understand, because that will govern your right to your own investment in the future. And my recommendation is take legal advice.
Yes. Good one. And that heads to number 4. What is that?
That will be, it can be in the shareholders agreement somewhere else, but typically in the shareholders agreement, that you as an angel investor sign a non-compete. And if you're a passive angel investor, like in your example, you come from real estate, you want to invest in food tech, why should you sign a non-compete in that food tech? Imagine that will cover all of the hospitality industry, because that delivers food in some way or delivers takeaways. Then if you go and invest in a hospitality startup somewhere else, you might be in conflict with that shareholders agreement, because that might even say that you're not allowed to invest in competing businesses.
Okay.
So it can be really broadly defined, and really broadly what type of activities you're not allowed to do. And as an angel investor, if you're passive, I would say make sure you have a carve out. So the founders should absolutely have one. It would be a legal mistake not to have them under a non-compete. But you, as a passive investor, should not accept it.
Okay.
But
again,
in your example, you being in real estate, wanting to invest in that food tech, if they say, please come on our board of directors, be involved in our strategy, be active, what do you say? Then it might be reasonable.
Yeah.
So it depends on your role.
Yeah, and how much you're willing to give.
Yeah, how involved are you? How much confidential information will you get? How much can you hurt the company?
Okay, really good. That takes us to number 5. What should we avoid?
You should avoid. A legal mistake will be not to ensure that you have information rights. I mean, once the company grows, you cannot be that annoying angel investor calling the founders each week. Absolutely not. But make sure you know what's happening, because remember, those founders, they're spending your money. So you need some kind of information in the beginning. What's happening? How's the budget? Are they really following it? What's happening? Etc. Or are they a lifestyle startup where they start to go, they need to visit San Francisco for a conference, and then they absolutely need to be in New York to make a speech, and then they need to be in a podcast in London, and that's your money traveling around. Is that really the best for the startup? So make sure you know what's going on with the budget.
Okay, that's good.
Yeah.
So number 6 then.
Number 6, that will be signing too far-reaching clauses for liquidated damages. And liquidated damages, that is whenever you commit a breach in relation to shareholders agreement or NDA, non-disclosure agreement, they do not have to prove any damages. You still need to pay that amount, that liquidated damages. So make sure you don't accept them. My baseline is never to accept sign liquidated damages. Perhaps in some really extreme example where I know I can control if I commit a breach or not, there's some super proprietary secret, something that I get my hands on. But otherwise, I say don't sign it.
Don't sign it.
It's too much of a risk.
Yeah. So number 7, what is that?
Number 7 of the legal mistakes will be believing that the shareholders agreement that you sign will last forever.
Okay, and how do I not? It don't.
Well, 2 ways. Number 1, typically in the shareholders agreement that you do sign, there will be an amendment clause. So that will say that 75% and the positive vote of the founders will have a right to amend the shareholders agreement. So even if you say no, they can, or 95%, I don't know. But typically there will be a clause. And also, if a venture capital comes in, they will look at your shareholders agreement and say, brilliant. Now, this is the shareholders agreement we'll use. And then you will be forced to sign it if you want the investment in its venture capital. You will want it, most likely.
Yeah, because it's often a lot of money, right?
Yeah. So expect that even if you're a super important angel investor in the beginning, once the VC comes in, you will only be a passive minority holder.
Okay.
So be realistic about that. Don't be sad or shocked about it.
And that takes us to number 8.
Number 8 will be not really fully understanding the investment vehicle offered. Because it can be directly new share issue, that's shares. It can be a promise, a simple agreement for future shares. You invest now and you get your shares later. It can be a convertible, a hybrid, a loan today that will convert into shares according to certain triggers in the future. So make sure you understand what type of investment structure, and this is also one of those get legal help, because not all of them are created equal, and you need to make sure you understand what the conversion terms and conditions are for you, because there can be tremendous legal mistakes if you don't.
Yeah, and you really want to avoid that.
Really, really, really. In particular, if you hit it big. What if you invest in that unicorn and it turns out you didn't even have a right to convert into shares because the agreement you signed said that only the company and the founders had a right to decide that you were going to convert?
So then it's nothing for me.
No, you get your money's back in some nice to have interest, like a savings account.
It's like giving a high five or something.
Yeah, exactly. Something exactly like that. Thank you. Bye-bye.
Oh, no, we don't want to do that.
We don't want to do that. So check the agreement.
Okay. And that takes us to number 9.
Number 9, that will actually be talking too much. Because the shareholders agreement and any other agreement that you sign in relation to that startup will have a confidentiality clause, meaning that you're not allowed to share, not even just trade secrets. Typically it will be broader. So be mindful, because like we talked about in episode 1, angel investment is a contact sport. You need to have the network, you need to be out there talking, knowing what's happened, discussing with different founders, with different angels. But be mindful about that confidentiality. And if you feel that you're expected to help with new fundraising or to talk, make sure you have a dialogue with the founders so they know what type of information you're sharing, so you don't end up in breach of a contract or with a dispute or anything like that.
That's really good.
Yeah.
That takes us to number 10.
Number 10 will be not documenting everything properly.
Wow.
skipping the documentation.
Yeah, we had a previous episode about that too.
Yeah.
But have you more examples?
What happens and what I've seen is founders calling me up super mad late, because they feel that they have not promised something. They have not promised anti-dilution protection for that stupid first angel investor who only invested 5K and they got 10% because it was also sweat equity, and they're so pissed. And then that angel investor calls me crying and saying that this is fraud. They promised me anti-dilution. I've been working day and night for free for this company. They promised me I would keep my equity stake the next 2 funding rounds. I was promised the anti-dilution protection.
So it's word against word.
Word against word. You win in discussions, you have some emails or text messages, hard to know what the last kind of final conclusion was. And this happens again and again and again.
So be transparent, sign the documents, and make sure that you agreed upon everything.
Because typically you think you're in agreement, and then you put it in the fine prints, and you're like, no, wait.
Yeah, because you might be friends forever. I mean, you're just business partner maybe after 2 to 3 years.
And funny things happen when you're getting close to big money, or you're about to lose it all.
Yeah.
In particular, when founders are about to lose also their reputation or prestige, they get stressed. And that's fully understandable, but make sure you have the documentation, what you agreed upon.
Good. Number 11.
Number 11.
Yes.
And that will be not understanding the shift in the exit strategy and the preconditions that comes when the venture capital comes in. That completely changes the game. And you as an angel investor need to know what is your return on investment, what you want out of it. And also, legal mistake, I would say, will be not seizing an exit opportunity in relation to the VC coming in.
Oh, so you're not counting on that?
Yeah.
Okay.
Because both, it can be that when the VC comes in, I mean, you might be happy with 10 or 5x on your investment. They might come in at such high valuation that they need, in relation to you, it needs to be 100x. And that might not be that probable, but they will never exit before that. And they have preference shares, so they are preferred in front of you even. So you need to understand that the name of the game will change, but you also need to know that when they come in, that can be an opportunity for you to exit if you don't want to wait and take that big opportunity. You want to bring home the monies. You're happy.
You're happy.
Yeah. And what you should also know then will be the valuation that they enter into. Expect that if you want to sell secondaries, there might be a discount on that. So don't expect to get exactly the same valuation. But typically, you will be very happy if they offer exit event because they kind of want to grow their ownership stake, and they want to clean the cap table. So a mistake would be not failing to take the opportunity if you want it, and not realizing the shift in the game that happens once you bring on VC, both in how the return rate, what's the valuation, how the exit will look, if it ever happens. But also that they might have preference shares, they might have anti-dilution protection, many other things that kind of will push your rights down.
Okay, so be prepared.
Know what's happening.
Know what's happening. That's really good. That takes us to number 12.
Number 12. That will be overpaying for your shares. Ouch.
I don't want to do that.
No.
So how do I not do that?
Well, that goes back to understanding the cap table and asking for the fully diluted information also. Because you should not calculate the valuation and your ownership stake only on what's currently having been issued shares. Also, promises for future equity. So it can be that the startup has a safe, it can be a convertible, and it can be employee stock options or options to other people or warrants. So make sure to calculate on a fully diluted basis so you don't overpay.
Remember that. Number 13.
That will be accepting a board position, feeling like, wow, we're talking about your food tech, you come from real estate, and your first angel investment, you get a board position.
Wow.
And it is It's a great honor. It's prestige. It's a legal position. It's fantastic. But it comes with legal obligations, requirements, liabilities. So make sure you understand that you will have, depending on the jurisdiction, fiduciary duties to safeguard the company and the shareholder collective's interest. So you need to be on point. You need to know how the finance is going. You need to make sure you're not getting close to bankruptcy and not filing for bankruptcy. Things like that. So you need to do the job, understand what you're getting yourself into.
The responsibilities.
Yeah, and make sure you have access to the financial reports or whatever you need to know to do your job.
That's good. So now we're at number 14.
The last
one. Bring it on.
Bring it on. And that will be in relation to an exit. If it is a share purchase agreement, they're selling the company. You, as a passive investor, being asked to sign business warranties. You shouldn't.
What is it?
We have warranties. That's you promising the buyer that some things are true. That you own your shares and that the company has paid all of its taxes, that it owns its intellectual property, etc. And you can divide those warranties into fundamental and business. The fundamental, you should sign, that you own your shares, that they're not pledged, that there's no issues. You know that. The business warranties, as an angel investor, you're not close to the business. The founders should sign that, not you. Because it will be a legal risk and you might end up with a lawsuit if any of those are not true. And you're not even able to verify that in a good way.
Okay, so that's really important.
Yep.
So wow, this is amazing, everyone.
Like bombing you with everything to think of.
No, we got 14 really good ways of not ending up in a lawsuit or discussions or any other things that you do not...
Or losing your monies.
Oh, or losing your monies. Thank you so much for sharing this.
Thank you. Happy. If we're going too quick, drop your comments down below. We'll stop, elaborate on anything you need.
Yes.
And this is not legal advice.
It's knowledge sharing.
And a bit of entertainment. At least we think so. we love the startup world.
We do. And please, if there's anything you want to know, just drop a comment down below. We're going to keep doing this, sharing knowledge about business law. That's what we love to do. And for you, it's at zero cost. So the legal tips and tricks and the inside information of the angel investment world. Wow.
Thank you. Lovely.
So, until next time.
Take care. Hej då.
Hej då.
If you have a tiny stake in the company, and you're super complex and you want to know everything and you have an opinion about everything, that can make it so time-consuming and so frustrating for the founder.
We are back with another episode on how to become an angel investor. And today we're going to talk about how to become an attractive angel investor. Sounds very, very, very interesting. And we have Kat here to explain what founders love and what founders hate. So you're here today to learn that to become the super investor that everybody wants. So let's rock.
Indeed.
Well, let's start. What should we start with?
Well, we can start with, the title being an angel investor. That's very attractive, right?
Yeah, it sounds really cool.
Yeah, it does. Many want to put it on their LinkedIn profile. But there's a great difference between calling yourself an angel investor and being one that's highly respected, that people want in their company, that people call up, that are asked to present at different conferences, that are invited by media to have an opinion, and so forth.
Yeah, it sounds like a big responsibility.
It does. And it's a different level if you're really that attractive, that respected angel investor or not. So we're going to let you in on the key kind of secrets or key do's and don'ts that not only founders hate or love from angels, but also that other angels will watch out for.
Okay. I hope you're ready. The first one.
The first one. Do not string the founders along.
And what do you mean by that?
Well, often happens that you hear stories about founders being super excited because they've had 3 meetings with this angel investor, and the angel investor is only super positive and very forward and only talking possibilities. And then time goes, meeting goes, conversation goes, and then there's a no. And many other angels and founders ask themselves, didn't you know early on that you weren't really going to invest? Perhaps you didn't have the cash right now. Perhaps you weren't really, really that interested, but you wanted to be nice, or you wanted to feel important, anything like that. Mm-hmm. So if you know early on that most likely I will not move forward, I will not invest, regardless of whether it's because of your financial situation, it's not the right timing, you don't really believe in the company, whatever. Let them know. Be upfront. They will respect you so much more if you tell it like it is. Because it takes so much time and energy from running the company, also doing the fundraising. So do not waste their time, do not waste your time, and they will respect you much more if you're a bit blunt and telling them that, honestly, I don't think this is for me.
Great tip. So be honest.
Be honest. Do not string them along.
Perfect. And the next one?
That is, do not play hard to get.
And why should you do that?
Another thing that will get angels a bad reputation, if they do want to invest or they are interested and they start playing dragons then. They start being a bit too important or ask critical questions in a way that kind of seems a bit rude almost. That's unnecessary. So if you are interested, you can be humble and kind and nice and ask the relevant question, ask for the information you need, but do not play too hard to get. Do not be a diva by any means, because that will give reason for frustration, and that will, in the long run, even though the founders will not tell you when they want your money, I promise you that, it will risk giving you a bad reputation. And also other angels will see that kind of behavior as a turnoff.
So it's better to cooperate in the beginning and have good communications, because you're going to cooperate in the future as well.
Yeah. So even if you're asking tough questions, do it in a humble and respectful way. Even if you can't give a notice directly if you want to invest or not, be clear about it. Do not play too like,
So what do you got here?
Yeah, exactly. So that's a do not.
Okay, that's a really good one.
Yeah.
I think that might be a common thing to do if you're new into the investment world, and you're gonna stand up for something that you've never been in, and then I just act as something I'm not.
Exactly, and you've seen the cool guys on Dragon's Den asking the a bit tough, rough questions.
Yes.
But that's to make a good TV show.
Yeah, of course it is.
Yeah.
So maybe you should put it the other way around. If someone asked me questions like that, how would I feel?
And also, if you want to get the best information about the company, about the founders before you invest, do you think that comes from being really rude and aggressive? Or does that come from building a climate of trust? So it's a win-win.
Yeah, trust. I think that's an important one.
Yeah.
So next one. What
Number
to do
3.
not? Yes.
Yeah. Do not, once you have invested, be too information demanding.
Okay.
One thing that will give an angel a bad reputation is if you call the founders each week. If you have a tiny stake in the company and you're super complex and you want to know everything and you have an opinion about everything, that can make it so time-consuming and so frustrating for the founders. And they will not like that, and they will let the community know. Other angels will see that, and they will not like that because you are detracting the founders from building the company.
Oh, so you don't want to be a pain in the... Good. So let's move on. The next one.
Number 4,
yes.
It's a do. Do show your value add. We talked about that in another episode about how to define your role as an angel investor.
Yeah.
And most angels have more than just money to give. They have a great network, or they have some kind of incredible competence. It can be that you are really known in the industry, in food tech, in real estate, what have you. Or it can be a general competence like a business lawyer or marketing expertise or communication expert. So show your value add. Can you help in some other way? That will be super attractive and really make you an attractive angel if you can bring more to the table than just cash.
Wow. So the next one.
The next one is do not over-promise.
And what do you mean by that?
That is a hated one.
Yeah, I can see.
That is, if you sit prior to the investment and you talk about all the possibilities and you start telling them that you know this person, you know that company, you can help get a meeting with them and you can help out with that. And then once you made the investment, the phone goes quiet.
Oh.
And the founder calls and said, hey, what about that meeting with that big company that I really want as a customer? And you were like, well, yeah, I'll catch up. I've been a bit busy. I'll call you in a couple of weeks. And you never do.
Okay, so be mindful.
Yeah. Or if you tell them that you're going to help with fundraising, then really help with fundraising. Do not over-promise. That will give you a bad reputation.
Okay, so stay clear with your attention and follow up on it.
Yeah.
Great one. So number 5?
Yeah, number 5 will be do not spread rumors.
That's never a good one.
That's never a good one. And for someone who's been in this industry for 16 years as a business lawyer, I mean, it's a crazy, crazy fun world, the startup world. I mean, entrepreneurs are eccentric.
Yeah.
There's crazy money if you hit the unicorns, right? And there's a lot of conflicts because there are a lot of A-type personalities, people claiming it was my idea, it was stolen, something happened, something didn't happen. Somebody feels they were promised something that never happened. So the war stories that you carry as an angel investor will be magic. But be mindful. It's a tight community. Rumors are seldom true. So do not be that type of angel investor who every time you sit down with a new founder, a new angel, start bad-mouthing others. In particular, if somebody that you feel frustrated because you were promised something or you feel kind of did not respect you in some way. Be mindful. Talk to people. I mean, you need to be able to let your heart out. Talk to your closest, the ones you trust. And then you can ventilize. But do not spread rumors. That will never end up in your favor and most likely will make you look bad and not the people you're talking about.
No, that's really true.
Yeah.
So that was a good tip.
Yeah.
So next one, that's number 6.
Number 6. That will be show that you understand it's a long game and show that you understand that your position and your relevance to the company in the beginning as one of the few shareholders, the angel helping it in the beginning, will shift. So if the company does grow and does bring on the venture capital, your role, your relevance will be tiny, tiny, tiny. So don't get frustrated that the founders call you up every month in the beginning asking you for support and help, and they stop calling once the company is growing. Do not feel frustrated that you do not know everything that's happening once the company grows. That will only give you a bad reputation if you are
Too controlling or too demanding?
Yeah, and that you feel kind of let down because you're not as involved anymore. Show that you understand that your role will shift. It's a long game and you will be more relevant in the beginning and less relevant in the end, and you will have less of a say-so the more the company grows. And that's it.
That's it. That's really
Easy
good,
peasy.
like socially good tips and tricks that you can use because, I mean, if it's a new world, you don't know how to act. You just want to be one of the good guys or the big guys.
Exactly. And many of the do's and don'ts actually come from a good place.
Yes.
Like, don't string the founders along. You might just want to be nice, but on the contrary, you will create frustration once you do let them know that you weren't interested and they wasted their time.
Yeah, as you said, wasting each other's time. Yeah.
And as we discussed in another episode, being a good angel investor, getting good returns on your investment, it's a contact sport. So really do be mindful about building your network and the community in the right way.
That's so good. Now you know what founders love and what they hate, and how you can be a really attractive investor in your beginning to start the angel investing journey.
And making more cash.
Making more cash, of course. And I really hope you do that out there, because this is a really fun sport, as Kat was saying here.
Yeah, it's good calling it a sport, I agree.
I love that.
Yeah.
So thank you for sharing your knowledge as an angel investor too. Don't forget to mention that.
Yeah, indeed.
So
done many mistakes myself, so happy to share them.
That's so good. Thanks for everything today.
Thank you.
See you next time.
Hej då!
Hej då!
And they say, you know what, I'll buy you up. So most likely, you will only save your investment, get the money back, or you make a tiny okay.
We are back with our masterclass about how to become an angel investor. And now we're headed to the 6th episode.
The last one.
The last one. And today we're going to talk about 8 different ways that you can exit your startup. We call it the get rich moment. And you do not want to miss this one, because some strategies will be really, really good and some strategies will be catastrophe. So stay tuned, because in this episode we will present both bad and good ways to exit your startup.
Yeah.
So this is going to be so interesting. And we have the business lawyer, of course, with us. He's going to take us through.
Yeah. And when you say good and bad ways, you mean like amazing, get rich moments, and catastrophe. Lose your entire investment ways.
That sounds like a catastrophe.
Yeah.
So let's start.
Yeah. So number 1, the most common exit of the positive ones will be a trade sale. You sell your company. Often you call it an M&A deal, mergers and acquisitions. We're talking about the acquisition part here. That means that a bigger company buys your company.
The whole company?
Yeah, the whole company.
Oh.
So as long as that sale, that the acquisition is done at a higher valuation than the one you entered into, you will make that return of investment. So that can be anywhere from 2x your investment to hundreds of x in the unicorn situation.
So it can be a really good deal.
Yeah. And that's what you want. As an angel investor, you enter in so early at such a low valuation. And what's good to know is that when that type of exit can occur will be dependent on a large part if you have brought in venture capital money or not. And that is, if you bring on venture capital money, then you will need the valuation to be much higher before it makes sense for them to allow that exit to occur. So, if you bring in VC money, which is good for you as an angel investor to talk with the founders about in the beginning, what's their aim, what's their goal. They cannot promise that they will do the venture capital journey, but you can know what they're aiming for. Then it's higher risk, but also even higher reward. If they're looking for a more decent type of sale, it can be a 10x. They sell their company for 100 millions or instead of billions, which means that you might make a 10x or 20x or 5x. So that's a bit lower risk, but the return of investment will be lower as compared to the venture capital journey.
Okay.
But that's a typical, the most common will be the acquisition, selling your company, being bought by another company.
Yeah, and you call it trade sale.
Yeah. Typically that will be somebody who's in the same type of industry as you. It might be Google buying a tech company. It might be a big pharma buying your health tech company. If you're in food, it might be Walmart buying you. Who knows?
So
something like that.
It's a dream scenario.
Yeah, because they're looking for the innovation, the creativity that's hard for them to find within their own research and development only. I mean, if they're looking at the startup world, they suddenly have the whole world as their menu to choose from. So that's kind of the name of the game.
Trade sale. We're moving on to the next way. What is that?
The next way will be the IPO. That is the golden standard, the dream of most founders.
Tell me more about it.
Yeah, it's getting, you go to the public market, to a stock market, to the exchange, the initial public offering, the IPO. And that typically will mean a brilliant return, a brilliant get-rich moment for you as an early angel. But what you need to think about is that typically in the IPO, once you go to the stock market, there will be a lock-in phase, which means that even if the valuation when you get publicly trading is much higher than the valuation you entered into, you will be locked in, so you're not allowed to sell your shares for a period between 6 months and 24 months. And in that time period, guess what? The stock can plummet. And that has happened many times.
So you can risk to lose your money in that case.
Absolutely. If you're still locked in and you cannot sell at that top when the IPO happened, and it does not go up as you all count on and hope for, but instead it plummets, absolutely. And also be mindful that an IPO, not all IPOs are those big grand IPOs on the New York Nasdaq Stock Exchange. They can be on a tiny, unregulated market in Stockholm. So, and then the liquidity will be much, much lower and the risk much, much higher. So be mindful that just because you were talking about the IPO, it might not be that get-rich moment for you. So watch out a bit also.
But is it mandatory to do that lock version?
It's not mandatory, but most exchanges will demand that from the company. And the reason is that that is a protection in relation to the public that gets offered your shares, that you have not inflated the value just to run off the day that the public gets access to your shares. So it's kind of a promise that you have skin in the game, that the valuation will uphold.
Okay, then I understand. Thank you. So, and the third way?
The third way will be a secondary sale. That means that the company does not do a proper exit, but you will exit. You will sell your shares to somebody else. It can be in relation to a new funding round when the new investor coming in wants to top up their total ownership. Typically, when you do a secondary sale, it will happen at a discount compared to the valuation at the new funding round. So watch out for that. Be mindful. And also have a look at the shareholders' agreement, as we talked about in another episode. Because typically there will be restrictions on the transfer. So you cannot go about promising to sell your shares to anybody without looking. Is there a right to first refusal, etc., that you need to adhere to before you can sell a secondary sale.
Okay.
And typically, this is a okay get-rich moment. It's not the wow get-rich moment, but it's a good get-rich moment. And typically, it can happen much faster than waiting for the company doing a proper IPO or getting sold in its entirety.
So that was a secondary sale.
Exactly. You really sell your shares on a secondary market.
Okay.
To another shareholder, another buyer.
Okay. We're moving on to the fourth one.
Yeah, and that's a bit more unusual. That would be the merger. We talked about the M&A, and we're going to look at them separately here because they do warrant that. The merger will be that your company merges with another company. So they merge together.
Okay.
And typically, often that can be a cover-up because it's actually acquisition, but you call it a merger to kind of keep your pride. But anywho, the merger will typically mean that you, as a shareholder in the company that's getting merged, will not get cash in hand. Instead, what you will have is shares in the surviving entity. And if it's not your company, it will be the other company or the new entity that will hold both companies.
So you like come along to the merge? Okay.
Yeah. So first you hold shares in your startup, and after the merger, you hold shares in a bigger company. That's the combination of the two companies. So it will not be a proper exit. That means you have cash in hand, but you will exit that startup for something bigger.
Okay, but why is it more uncommon to do like this?
Good question. I think it's just easier to buy a company. More straightforward, because typically one company is stronger than the other. And if you want a quasi-merger, even if it's an acquisition, you can pay in part with shares in the buying company. So it's kind of, the difference between the two is kind of new, it's floating.
It's floating.
Yeah, it's not a clear cut, and that's why you typically call it M&A, not acquisition or merger. But here, to make sure you really grasp the name of the game, we've separated them to really explain.
So the fifth one.
The fifth one, this will be when you do not sell the company. You keep your shares as a baseline, but instead, if you have a tech company, you will license out the tech, or you will sell the assets of the company.
Okay, so not the whole company, only the assets.
Yeah. The part that's actually valuable of the company will be sold out in some way or form, so that the entity that you hold shares in, the startup, will gain cash or value instead. And then either you liquidate that company and get the cash in hand, if it's an asset sale, or if it's a licensing, you might pay dividend ongoingly. And typically, this is also an okay get-rich moment, not the great get-rich moment. It will be less of a good return of investment compared to the acquisition, getting bought, or the IPO, typically. So it's a more complex way, but still it will get the company some kind of revenue and you some kind of return of investment, hopefully. Hopefully.
So now we're at the number 6.
Number 6. And that will be the buyback. This is when the founders turn to the early angel investors and say, you know what? Typically, it's because the company is not going as good as planned, because you had this brilliant plan, right? And they say, you know what? I'll buy you out. I'll buy you out, so I will own the company. I will run it my way. I will do it my way. So most likely, you will only save your investment, get the money back, or you make a tiny, okay return of investment.
Okay. So in that case, why do you get sold out?
Well, typically the company is kind of stagnated, and you don't see a chance to get a really good return of investment, a really great exit. But the founders still believe in the company and take ownership over it and want to kind of restructure it or just run it and make it more solid as it is. Or it can be that you and the founder have a conflict. It's something in between you two, so you're not really working out. So the founders say, you know what, it's better we go part ways. I'll buy you out. What if I give you 1.5 of your investment back? Is that a deal? Something like that.
Okay. And the 7th one?
7th one will be a liquidation or bankruptcy.
Bankruptcy. Doesn't sound so good.
No.
So explain
This is the bad. We talked about liquidation when you've done an asset sale. Now we're just talking about liquidating the company, selling the assets either voluntarily or mandatory, because you cannot pay your bills in time, etc. Or bankruptcy. So it's a kind of declining scale we're talking about here.
Okay.
Anyway, not good. Most typically, you will not see a dime. If it's a bankruptcy, it's over.
It's over.
It's over.
Time out.
Yeah. Most startups do fail. Ouch.
Yeah, they do. It's a harsh reality.
Yeah.
So the last one.
Number 8.
Yes, we're at number 8 now.
And this is one that you might not hear about that often as an angel investor. But that is actually that the company does not manage to get an exit, but it's not failing as a bankruptcy. It stays a private company going okay.
And nothing special happens.
No. And that can be either frustrating because you can't really find a liquidity event, you cannot sell, you cannot get a return on investment, or it can be great. It might be a steady growth, it might pay dividend every year. That might even be better than a one-off exit. So it might not be as boring as it sounds that the company sticks. It's just important to know that you can get your return on investment some way. Because even if you want to do a secondary sale, if the company stays private, you need to show that buyer why they would want to invest. How can they get a return on investment? And it often happens. A company goes okay.
The company goes okay. And it's a good one too. I mean, it's not bad.
No, exactly. As long as you don't lose and you see some kind of dividend or something that makes it worth it. Because you don't want to put your money in and never see it again and just wait. Right?
But is it a good long-term strategy to find a company like that?
If it pays dividend, yes.
Oh, so you get money every year?
Yeah. Because otherwise, again, you put it in a hole and you never see it. But if it gives you something back ongoingly, it can be brilliant.
Yeah, I imagine for you, maybe you do a big profit in the end.
Absolutely.
That's really good ways.
Yeah.
The get rich moment. We talked about 8 different ways how you could exit your startup.
Yeah. The truth. So the good ones and
the bad ones.
Yeah.
But I mean, anything can happen, and we hope for the big money for you guys.
Yeah. And also, once you heard all of these 8 ways, a good thing would be for you to look at them and talk to your investor. I mean, even share this episode with the founders. With the founders or other angel investors who you're talking about doing a deal with, and discuss. Okay, so where do we see ourselves? Even if you're already in the game, talk it through. What's a proper exit strategy for us? And some people say that every founder should have an exit strategy day one. Some people say, no, they should focus on building a strong company, a solid company. The truth is somewhere in between. But looking at all of these options, talking it through, thinking it through, where are we? How can we navigate to get where we want? That can be really helpful.
But is it common to talk about the exit strategy in the beginning on the investment? We talked about it on the checklist.
Yeah. And I'm going to say it's really, really different. Different investors see it differently. So it's kind of hard for a founder to know what to answer when they get the question. Because some people hate it when the founders are super exit. We're going to flip the company in 2 years. And some people love it. They say, oh, we have a clear exit strategy. You know exactly that it's Google who's going to buy you. So find your way. Find a middle ground. Be realistic. Do talk about it. But talk about it when it's appropriate in an appropriate manner. And first and foremost, think about it in relation to your own finance and your own investment goals. Where are you at? High risk, etc.
Really good. Thank you for explaining to us.
Thank you.
And I hope you really learned from this, because I truly do. It's so interesting. And I hope your businesses are going so well out there.
We do.
And do share our channel to your friends and to your colleagues and people in your branch, because we're going to keep sharing this business law knowledge. Now you listen to the 6th episode of How to Become an Angel Investor. So now you can just start your journey.
Good luck. Stay tuned.
Good luck.
Hej då! Sometimes you call it a lifestyle startup. And that's a warning sign, not a good one. The founders are too focused on going around networking too early.
We presented to you 6 different episodes on how to become an angel investor. It's been so interesting listening to Kat explaining, both for you as a business lawyer, but also as an angel investor. So, I mean, I feel more equipped than ever to start now.
Good. Really good.
We share strategies, tips, and tricks and such things. So, I'm going to share an example with you. So, let's say that I'm interested in a company. It's a food tech company. A very famous person is behind the company. She's now retiring, but she worked as a chef all over the world. And now she's creating like a food tech app where you can buy local produced food. So you can have it in your community worldwide. So it's like put together different farmers and if you have fruits and stuff.
Okay.
And I got the opportunity to invest because I known her from when I worked in real estate, but I do not have any like competence about food tech or food or restaurants, except that I had like locals that I was giving her. So I got the opportunity and she asked if I was interested because I had 2 million that I had from, I sold some properties. So I can do something with them. So what am I gonna do? So I learned a lot from all the things that you shared. And also there is 2 really important person that backing this company as well. Like a really good marketing person named Lily Zhang. And then we have a really good SEO that called Max Harper. And he's been creating like unicorn businesses.
Okay.
So I'm interested in starting to invest. And now that I learned so much.
You talk about the tech company. How far along are they?
I mean, in the beginning.
Do they have actual technology or do they aim to develop it?
No, they have technology.
They have developed technology.
Yeah.
So that's a plus when you look at the due diligence. You want to see proof of that. Can they show you something concrete about that technology that makes it unique and protected?
I haven't watched that. But I can do that. I can ask for it.
Good. And when you look at the team, you mentioned that she's a famous chef, so she has that competence, that good reputation. You mentioned she was backed by 2 other angel investors already. And what typically you say, look at the team when you do the due diligence, right? I'm going to say, if you're an early angel investor, do not expect a perfect team.
Okay.
Too early, you will not have a team. Instead, look at her. What was her name?
Isabella Legrand.
Isabella.
Yeah.
So is Isabella the type of person that you feel can attract and build the perfect team along the way? Do you
think she is.
Yeah.
Definitely.
So she has experience, reputation, and you think she's the one that can build the team, realize that she does not know it all. So that's really good.
Yeah.
And then when it comes to due diligence and the pitch deck, I guess they showed you?
Yes, I actually got one of those.
Did you feel that it was clear what market they addressed, the total addressable market they call it? You said it was worldwide.
Yes. So I have some question because they didn't talk about like specifics on how to do it in other countries and such things. Can I ask for that?
I love that because a typical problem will be that the total addressable market, either it's too small, you're solving a brilliant problem, but there's no market for it, or you take everything is the total addressable market. And that's not realistic.
No, it sounds too big.
Exactly. So is it a realistic total addressable market? And is it realistic, the share of that they think they can take? So that's something you can ask Isabella.
Yeah, I will do that. And then the next thing I was thinking about is all the documents. So, I mean, I asked for cap table if there were other people involved.
Yeah, and you mentioned that there were 2 other backers. So it would be brilliant for you to see the cap table, see the shareholders agreement, and understand how big investors are they. Because I typically, personally, when I invest in a company, you say, look at the team and everything. I typically look at what other angels are in. And I know most of you think the same way. Because if you have really good angel investors, I mean, you need to make your own assessment. But that will be a good starting point. Because they have the network and experience that you can draw from. So when I've invested in food companies, fast-moving consumer goods, actually, I've invested alongside angels who have done investments in other fast-moving consumer goods companies who have become unicorns. And I feel that that's a good receipt, kind of a good telltale sign. So that can be good. Look at the cap table, look at the shareholders agreement, see how involved they are. Are they on the board? Are they contributing, or is she only using their name, really?
I should really look on that one.
Yeah.
And then they were asking about like how I want to participate. I mean, how if I want to be a passive or active investor. And I don't really know how to think there because I don't know so much about food tech. So what can I bring to the table?
Well, you mentioned you come from retail.
Yes.
And you mentioned you had already helped them a bit with facilities.
Yes.
Was it the offices or
offices
warehouse?
and 2 restaurants.
Okay, yeah.
But I wasn't too involved in like the restaurant building. But
But you help with the network,
Yes.
the introduction. That's fantastic. Typically, that will be what a company wants. And we talked about doing angel investments that do give return of investment has two sides. It would be the quantitative aspect. Most startups do fail, but if you do many, you will find a good one. But also qualitative aspect and doing the due diligence, evaluating the company, but also contributing. It's a way to enhance the chance that that startup will be a success. So if you have a network that's relevant and that's not her own, that will be really helpful and that can really be a value add for you.
Yeah, so then I can be like an active investor.
Yeah.
Because I really want to do that because I'm very interested in the company.
And actually, when you start as an angel investment, the first investment can actually be kind of advertising money for yourself, to be honest. To grow your network, to become known, to get to do the really good investments once you've learned. So it might be strategic for you to invest alongside these renowned investors being active, so you can learn and you can build your reputation.
Sounds really good.
Yeah.
I'm a bit nervous, but to start this journey. But when you talk it, I feel more comfortable doing it.
And another thing I think you should look at and discuss, when you looked at that pitch deck and the financial prognosis, do you feel that it's clear what your money, what this funding round will be used for? Was that clear?
No, not too much, because they want to start like creating the app. They have the idea and they have all the technology. So that's where they are right now, and they really want to start just get going.
Yeah, because that can be a good, important step before you invest also. Do you really understand what your money will be used for? Because will it only be used for Isabella feeling that she needs to go to conferences all over the world and doing PR? Maybe not.
Maybe not.
Warning sign.
But I can ask her.
Yeah, sometimes you call it a lifestyle startup. And that's a warning sign, not a good one. If the founders are too focused on going around networking too early instead of building the company. And also, did you feel that the cost for building the app, are they realistic? Because often it can be like, we'll do it in 6 months for 2 million. And then 12 months later, you're still doing the iterations. You don't even have your MVP.
That's
money down the drain.
Yeah, it was quite expensive to create the app. And I asked if there was like a long-going project or if there's going to be like a certain amount of time. And I don't think they haven't decided really how to do it.
And I mean, that's good. At least they don't underestimate the cost then.
No, exactly. Yeah. So that feels good.
Yeah, and flexibility can also be a very positive.
Yeah.
And hopefully they're aiming to get something out on the market quickly. You know, you've all heard of a minimum viable product, MVP. Hurry up and fail, hurry up and get out of the building. So you don't stay in and spending all of that money going to do something perfect, and then you go to the market and the market wants something else and you have to pivot, do something else. Better get out there and get feedback early on, like Facebook did. They tried and tested, and if they hated it, they did something else. So they knew without spending money and time doing the wrong thing.
And then I have a question about the IP. I mean, how can I guarantee, because we hired a third part doing the app.
Okay.
How can I guarantee like everything is as it should be so I don't get claims against me or something?
Against the company, you mean?
Exactly.
Because as an investor, you're safe.
Thank you.
A passive minor investor not on the board, you will not be responsible for the company's obligations.
Okay, that's good to know.
Yeah, that has to be something you do something crazy if they're gonna pierce the corporate whale going after you now. But you want to see that the IP ends up the ownership, even if they're using third parties, not employees, consultants, that they do give all of the IP to the company directly, so that there can be no claims that they actually own it or have entitlement for it. Oh, and the same should be with the employment agreement, of course. So you know that the IP and the founder should not own the IP. The company should own the IP.
Okay, that I'm really going to have in mind.
Yeah, that's a really good one.
And then when we talked about creating the shareholders agreement, I mean, that was a lot to think of.
Yeah, and we have a red flag about what to watch out for. But if she already had 2 savvy angel investors in, she most likely has an agreement. Most likely, it will be very founder friendly in the beginning. And most likely, you have to be ready that once you grow, because she was going after the world, right?
Yeah.
And you bring in venture capital or more bigger investments, that shareholders agreement will be torn up and replaced by a new one.
Oh.
So even if in the current shareholders agreement, you might have a more important role, you might have a board position, you might have information rights, etc. Because you're 1 out of 4 right now, right?
Yeah.
Once somebody bigger comes in, they will tear it all up and want something else and make claims and want the preferred rights, board position, veto rights, etc.
But what happened to me, to my part then?
You will probably a passive minority angel investor. You will not be able to have any impact on the company at all.
So as soon as the VC capital comes in, everything changes.
Yeah. So if you do angel investments in a company that goes for the VC, the big scaling, you have to expect that you will not be able to control or protect your investment along. You're along for the ride. Either you can aim to do a secondary sale or a quick exit, or you stay tuned and hope for the best in the end. You can affect in the beginning, but no, you're just a minority shareholder afterwards, unless you get employed and you take a position in the company, which also happens. Angel investors being involved in the beginning and they love it so much and they have a important position, so you jump on board. But otherwise, expect that you will not be more than a minority, not being able to control or protect your investment along the ride. But you will also have a return of investment that will pay for everybody, and that you will get a payoff for everybody else's hard work if you're on top.
So it can also be a good one for me.
Whoa, yes. They did the hard work. You got all of the benefit. So
we're hoping for that.
Yeah, exactly. So there is a reason why we all jump on board to get to be angel investors.
Wow. So it's very exciting to start the journey.
Yeah. And also the brag rights, if you can claim that you were one of the early investors of a new Facebook or Instagram or Oatly or whatever. I mean, everybody will be rolling the red carpet for you.
Yes.
So if you do get that big winner.
Yeah, I really believe in this company.
Yeah.
So I think it could be something really big.
That's exciting. And also, I mean, it should be stressed that being an angel investor is also about supporting a startup, supporting a brilliant founder, building that community. So that has a value in itself and can be an incredible door opener for you in many different ways.
Thank you. So yeah, I'm going to start now, and these episodes have been really helpful for me.
And hopefully all these questions that I've been dumping on Ida now can be helpful. So do review them. Do think, do I have the answers to this? Have I done a check on my Isabella, my founder? Have I heard about her before? Has she started other companies successfully or not? Is there any other angels who have done successful exits before, etc.? All of this. Use them. Ask questions. Do fall in love with the founders, but do have a sounding board. You can use us. You can use somebody else. And this is not
legal advice. This is knowledge sharing, which we are really happy to share.
Indeed.
So thank you for everything.
Thank you.
So all the angel investors, go out to the world and have fun.
And all you founders, hear this. Be ready for the questions. Help the angel investors to choose you.
That was a good one. Thank you so much.
Thank you.
Hej då.
Hej då.